Good morning. My name is George Blackburn, and I am the owner of Blackburn and Sons, the uh, California-based hard money commercial lender. And I'm also the owner of cloans.com, the commercial mortgage portal. Today I'm going to give you a primer on structured finance. Now, structured finance involves three basic types of financing. The first is mezzanine loans, the second is preferred equity, and the third is venture equity. And we're going to talk briefly about each one of these three. Let's talk first about mezzanine financing. What on earth is a mezzanine loan? A mezzanine loan is not a mortgage. It is a loan against, in order to keep this simple, let's say it's a loan against the stock of a corporation that owns real estate. Okay, that's a really easy way for you to understand it. Now, people don't use, C corps anymore unless they intend to go public. Most real estate properties are owned by LLCs. So when I'm using the term the stock, what I'm really referring to is the membership interest in an LLC that owns a particular property. But I think it's easier conceptually if you understand that you think of the membership interest of an LLC as if it were the stock of a corporation. So I'm going to use stock of the corporation rather than membership interest of an LLC, but basically it's the same thing. And by the way, mezzanine lenders would do either way. They'd be just as happy to make the loan against the stock as they would against the membership interest of an LLC. Okay, now imagine this scenario. A corporation owns a big office tower in New York City, and it's the only asset that they own. Now, if you owned all of the stock of the corporation and the corporation owned all of the big office tower, then you would own all of the office tower. Okay? Now, so what happens is that a borrower needs a loan, and the lender looks at the deal and says, this is too risky for a mortgage. I want to be able to foreclose quicker. So what they do is they make a loan against the stock of the corporation that owns the building. Now, if the borrower defaults on the loan, they foreclose on the stock. But the nice thing is that stock is personal property. It's not real estate. It's personal property. It's like a car. If you don't make your payments on a car, does it take a year to foreclose on your car? No. You don't make the payments on the car, they send you a notice. Next thing you know, you go to a McDonald's, you come out with your hamburger, and they're towing away your car. And they're going to have an auction for the car. You're welcome to bid at the auction, but you probably don't have, if you can't make the payments, you don't have the dough to bid at the auction, and so your car gets sold at auction maybe 2 weeks later or something like that. Now, the same concept is also true with a loan against the stock of a corporation. If you don't make your payments on the loan, they go and they seize the stock, and then they hold a public auction for those shares of stock. And the nice thing is, it doesn't take a year to foreclose. I'm a hard money lender, and I once made a loan in New York State, and it took me 13 or 14 months to foreclose. Their laws are so slow there, the foreclosure process. And it was awful. It was absolutely horrible, during which time the property had really declined in condition. The roof had started to leak, mold had started to form. It's awful. You don't want to have to take 14 months to foreclose. Now, mezzanine lenders make loans on typically great big office towers, shopping centers. Those would be the main collateral for mezzanine loans. And they typically are junior to, in other words, there's normally a huge first mortgage on the property from either a life insurance company or a CMBS lender, a conduit. CMBS, commercial mortgage-backed securities. It's a conduit loan. Now, those loans have huge prepayment penalties, and they forbid junior financing. But if arranged properly, it is occasionally possible to put a mezzanine loan behind a CMBS loan. Now, those loans often take the total debt stack from maybe 65% loan to value up to, 75, maybe 78% in today's Great Recession times. So that's a pretty risky loan in terms of being very high in the debt stack. So the mezzanine lender wants to be able to foreclose quickly. Now, mezzanine loans are far more expensive than, let's say, mortgages. And typically, mezzanine lenders are looking for yields in the 10 to 12% range plus a couple of points. The loans are typically coterminous with the underlying first mortgage. In other words, if the first mortgage has 7 years left, they'll do a 7-year loan. If there's 4 years left on the first mortgage, they'll do a 4-year mezzanine loan, and so that both loans mature at the same time. Now, the thing about mezzanine loans is that the paperwork is ungodly, and very few mezzanine lenders will make a mezz loan of less than $5 million. So for most mortgage brokers, you're not going to be involved in the placement of mezzanine financing because normally the underlying financing is going to be $10 or $15 million. The second, it's not really a second mortgage. The mezzanine loan is going to be another $5 million, occasionally down to $3 million, but rarely. So those are pretty lofty stratospheres. And so you and I are typically not going to be involved in those, but at least now you're going to sound intelligent when you talk about those loans. Now, some CMBS and life company loan documents absolutely forbid mezzanine loans. So some clever people came up with a way of putting junior financing behind a great big CMBS loan or life company loan. And the way they do it, it's called preferred equity. Now, most life company contracts have a provision that say you're not allowed to put mezzanine financing, and any change of ownership of greater than 49% in the equitable ownership of this property constitutes a sale. The loan is suddenly due. You have to pay the enormous defeasance prepayment penalty, and it just makes life miserable. So what happens is a preferred equity lender, it's really not a loan. There are no required payments on the investment. But here's the way it works. They might have a preferred return of 14%. And if you don't make the preferred payments, there are provisions in the contract that say that they can take over the management of the property so that they make sure that you're not spending their dough elsewhere. They get their 14% preferred return. Basically, it's a fancy way of putting mezzanine financing on a property that doesn't qualify for legal reasons for a mezzanine loan. Now, preferred equity investors want yields between 14 and 16%. A typical deal might be 14% and 2 points, or 15% and 2 points. Now, the last type of structured finance is venture equity. Now, venture equity is where a very, very experienced developer goes to a kind of a go-go fund, let's say at an opportunity fund, and says, hey, we're going to build an office tower in New York City. We want you to, we have to put up, let's say, $5 million in equity. We'll put up $1 million, and I need another $4 million in equity. And that's venture equity. And venture equity companies or investors typically want yields, internal rates of returns north of 20%. So those are the three categories of structured finance: mezzanine loans, preferred equity, and venture equity. Realistically, though, in this great recession environment, no one is making venture equity investments right now. It's not something you want to waste your time on. Thank you.